It's Christmas Day and this is Business Morning. Merry Christmas to you and thank you for joining us. I'm Chimeze Obi Iwagu. It's a season of Thanksgiving and we cannot thank God enough for bringing us this far in the midst of the pandemic that is still ravaging the world. The year 2020 looked promising with lots of aspirations for everyone, but the turn of events showed that we can only make plans, but life always takes its course. From nowhere, a pandemic called COVID-19 enveloped the whole world, bringing every activity to a standstill and snuffing lives. The pandemic became a major destabilizing threat to the global economy, causing socio-economic disruption, including the largest global recession since the Great Depression. Oil demand plummeted, thereby affecting prices like the West Texas Intermediate dropping to an all-time low of minus $37 a barrel. Travel restrictions were imposed by many countries, which crippled the travel and tourism sector. I was privileged at the time to have a conversation with Nigeria's former finance minister and chair of Gavi, Dr. Ngozi Okonjo-Iweala, on the impact of the pandemic on countries, particularly Africa, and what needs to be done to access funding to sustain economies and how the vaccine, once available, will be accessible by lower-income countries.
Let me say that, this is a humanitarian crisis and then it's an economic crisis. And a lot of countries are already struggling with considerable debt. So it will be important to tap all the concessional resources available first, where you can get either grants, and there are several organizations that give grants like Gavi, the Global Vaccine Alliance, my organization. You have the Global Fund. They also give grants. Then you have low interest loans from some of the multilaterals, like the African Development Bank, the World Bank, the IMF, and so on. I would tap those sources first before trying to go on any capital markets at this time. I think those sources hopefully should be enough for the health aspect. Now, when it comes to economic recovery, then we begin to look at, okay, what additional sources? There's a concerted move by leaders on the continent who have appointed some of us as envoys, the African Union, to try and see how we can tap resources from all over the world to support the work that Africa is doing, both from the private sector, the public sector, the multilaterals. So what I'm trying to say to you is, for this kind of crisis, given that governments some of them are struggling with debt all over the continent, as much as one can leverage grants, very, very low interest loans first to deal with the crisis, that will be preferable to going on the capital markets at this time.
Our governments across the globe are coming up with different measures, stimulus packages and palliatives to cushion the effect of COVID-19. As a member of IMF's External Advisory Group on COVID-19, what's your take on the directions African governments have taken so far?
Yeah, thank you. Actually, the External Advisory Group is not just on COVID-19. It's just an external advisory board for the IMF. But let me come to the question you raised on measures that have been taken. You know that the African countries were hit first by the economic crisis before the health crisis. Once the COVID-19 pandemic started in China and then Europe and then the USA, demand for our products plummeted. Most people produce commodities on the continent. And so this has made a very huge economic impact. So we're already dealing with that before the pandemic really arrived and we started dealing with the health impact. I think that governments on the continent have made a very brave effort to try to do the lockdowns and the social distancing needed. The difficult thing, Chimeze, is that nobody quite knows how to fight this virus. So the only two instruments available right now are these lockdowns and social distancing, trying to keep people from going into crowds, asking them to observe good hygiene, constant hand washing. This is what is available, wearing masks, and so on and so forth. So I think governments have tried to practice that. It's actually quite courageous because when you do lockdowns on our continent, it's very difficult on people because many people earn their living on a daily basis. They have to go out and work to feed their families. So when you say lockdown, it means they can't earn anything. And they are wondering, how are we going to eat today? So you hear people talking of hunger virus killing them before coronavirus. So yes, the measures have been taken, but we need to do more, and we need to get additional resources. This virus is a pandemic. It's a global problem. On the economic front, the governments of Africa, on average, have tried to do fiscal stimulus of which amounts to about 0.8% of GDP. This is 1/10 of what has been done in the G7 countries. Their own goes from 8 to 10% of GDP, and Japan has even gone as high as 20%. So that means we don't have the fiscal space to be able to do more, meaning we don't have enough resources and revenues. And this is why it's important to try and raise additional resources for the continent outside. As AU envoy, along with 3 other colleagues, we're working really hard to see what types of resources we can raise. Part of it is asking for a debt standstill for 2 years, so countries don't have to pay, so they can use the resources to feed people, to make sure they have money in their pockets to buy the necessary equipment needed.
Right. Now, let's look at the recent debt relief announced by the G20 for the IDA countries. Is that enough to address the current economic situation, particularly for African countries?
The G20 has opened the door by saying that they would observe a standstill till the end of the year, 9 months or so. And this is good. It's an opening. We welcome that. But we believe that this is not enough. They have to go further. And we're asking for an across-the-board standstill for 2 years for all African countries, not just low-income countries, as they have indicated. We want it to be all countries. Because, you know, what we call the neighborhood effect. If you say that some middle-income countries, let's take South Africa, should not be looked at and they should not benefit. South Africa is very important to all the surrounding countries around it. They depend on South Africa's economy to also stimulate their own economy. So the same with Nigeria in West Africa. If Nigeria doesn't do well, it impacts all the other countries. So we'd like the entire continent to be considered for a standstill. And that's what we're pushing for. We're saying what they've done now is good, but it's not enough.
Now, but how many of these African countries, you know, is actually qualified for a debt relief?
Well, first, what we're saying is debt standstill. Debt standstill means let us halt payment of interest and principal for 2 years, just to release resources for countries to be able to take care of emergency measures. You know, instead of waiting for disbursement from somewhere, if you already have the resources you are going to use to pay for debt service, if they say don't pay interest and principal for a year or 2, you will have those resources immediately available to you to be able to strengthen safety nets, take care of poor people at the end of the spectrum who are looking for resources to eat. Buy the necessary medical equipment. We estimate that if you have a standstill for the continent, it will amount to about $44 billion per year. And this is quite a substantial sum that will be needed. So during this 2-year standstill, you can now look at the issue of, okay, which countries need debt restructuring, which ones need debt relief. The IMF already and the G20, as you said, have already agreed that the low-income countries will be able to get debt relief. The IMF has gone and announced 25 countries, 19 of them African countries, are going to get this debt relief. So during the 2 years, we will look at this issue and say, who qualifies for what kind of treatment? That will give us enough time to solve those issues.
Now, what are the typical conditions that a developing country will have to fulfill to be eligible for concessionary funding and soft terms from the multilateral agencies like the World Bank and the IMF and, of course, AFDB?
Well, for the issue of the fighting COVID-19, and trying to get emergency medical equipment and other needed things and trying to shore up the economy. I believe that many of the institutions right now are trying not to talk of the issue of conditionality. They're simply trying to get the resources disbursed quickly to countries so that they can deal with what is a humanitarian crisis. And on this continent, if we don't mobilize resources quickly, you can have a situation where you have a health crisis, an economic crisis, and maybe even a food crisis. Because you should remember, the people need food, need to be fed. So we have to make sure that our agriculture is working on the continent. So we don't have three types of crisis. So right now, I do not think there's an issue of conditionality. The institutions are simply trying to get money into the hands of countries so they can act.
And just as expected, the pandemic did not only take its toll on the global economy, the Nigerian economy as well. Government's revenue dwindled, galloping inflation, reduced economic activities, as well as the COVID-19-induced lockdown, and the result was recession. However, the Finance Minister, Zainab Ahmed, was optimistic about the future, but called on all hands to be on deck.
The National Bureau of Statistics released our third quarter GDP report. This GDP report, which measures economic growth, has indicated that the Nigerian GDP has declined by minus 3.62%. In real terms, that is in the third quarter, following a much larger contraction of minus 6.1% in the second quarter of 2020. Following the traditional definition, this means that Nigeria is technically in a recession. So we've entered our second recession over the past 5 years. This recession is clearly induced by the impact of COVID-19 and the national response that we have taken to contain the spread of the pandemic and its manifestation across several sectors is showing in the results of the second quarter. So for the third quarter, for the 3 quarters combined for 2020, the aggregate GDP decline is minus 2.69% year-on-year. This is a clear signal that the Nigerian economy is improving, that there are economic activities that are doing better than previous quarter, and there are 17 economic activities that have recorded positive growth in the third quarter compared to 13 in the second quarter of 2020. At the same time, there are also 36 out of 46 economic activities that have done better in the third quarter of 2020 than in the second quarter of 2020. The oil sector was largely responsible for the slowdown in the economic activity in this third quarter, as it recorded a very sharp contraction of minus 13.89%, the largest decline in this quarter in the past 14 quarters. The slowdown in global economic growth and oil demand consequent upon COVID-19 pandemic, as well as our obligations to meet OPEC cuts, were principally responsible for the slowdown in the oil and gas sector. Like the oil and gas sector, the non-oil sector also contracted in the third quarter of 2020. However, the decline in the non-oil sector by minus 2.51% year-on-year in the third quarter was significantly better when compared to the contraction of minus 6.05% in the second quarter of 2020. For broad sectors, agriculture remains resilient despite reported floods across some states, as well as the impact of the COVID-19 and also the non-COVID-19 production bottlenecks. The sector still remains resilient. The agricultural sector recorded a slightly slower but still positive year-on-year growth at 1.39% compared to 1.58% in the second quarter of 2020. On the other hand, industry recorded a decline of minus 6.12%, doing much better than the 12.05% recorded in the second quarter of 2020. Similarly, services also followed the same pattern of negative but better performance in the third quarter compared to the second quarter, recording a contraction of minus 5.49% in the third quarter compared to a decline of minus 6.79% in the second quarter. In the non-oil sector, the impact of the COVID-19 restrictions continued to be felt most significantly on the transport sector as well as on accommodation services.
Yes, much better than expected. But the question is, how much impact will the economic stimulus support by the federal government aid recovery and growth? The CEO of Financial Derivatives Company, Mr. Bismarck Rwani, says it goes beyond the stimulus. We need innovation to achieve positive growth.
The original fears and anticipation that Nigeria was technically and officially in recession, which means that you have 2 consecutive quarters of negative growth. However, the 3.6% contraction was much more shallow than was originally anticipated. Financial Derivatives Company projected a minus 4.7. Analyst consensus across the Bloomberg consensus was minus 5.6. So coming out at this level was much better than was originally feared. However, we must bear in mind a couple of things. One, that Q3 was when we reopened the economy in August. We opened the airports. We opened the land, interstate land borders. We allowed for partial activity, and so that happened. But it was in Q4, from October 21st, that we had the NSAS impact. So the NSAS impact is going to be felt in the Q4 numbers. However, we must also bear in mind that Nigeria also entered the region of what we call hyperinflation, where inflation had gone all the way from 12% to 14.3% and is expected to cross to 15% by next month. So when you have hyperinflation and negative growth, you come up with what we call the concept of stagflation. Stagflation is a very unique situation. If you look at almost all other countries, you are going to be told by many people that, oh yes, the growth is better than some other countries. But those countries do not have inflation in the region of 14%. So Nigeria has stagflation and has to deal with it in a very unique and actually innovative manner. So we need to be innovative. We have to be creative to deal with the situation of stagflation. We have the Monetary Policy Committee meeting during the week, next week. And so, one, they are going to be looking at the monetary policy to see that it is consistent with the fiscal stimulus that will take the economy out of recession. But the biggest fear is, how do you do this when there's hyperinflation, when the currency pressures exist, and when investors are at best skeptical about putting their money into the economy. The economic sustainability plan was actually launched sometime in the end of second quarter, and you are beginning to see some of the impact of that on the economy. That is why the depth of this recession wasn't as deep as was originally feared in Q3. But you will see the effect of that in Q4. Now, what we need to do is to reinforce the economic sustainability plan. We need to incentivize investors to bring money in, both international and domestic investors. And we have to understand that this is going to be a long, slow, and painful recovery. There's no silver bullet. So you are not going to see positive growth until sometime in 2021. And that is because our oil production and oil price, luckily the oil price was much stronger than was originally feared. And originally we thought the oil price would be about $30, $32, $33, but it came in average in the third quarter was $42. So our oil price was at least 30% above original projections. And so we need to pass the PIGB very quickly. We need to do something about the artificially low interest rates in the economy, which is actually a disincentive to investors and a disincentive to savings. So while saying that, some of the programs which have been embarked upon, Anchor Borrowers Program, and other things have to be continued. But we actually need to consider very strongly reopening our borders, which I think should be done very soon. We should also consider making sure that we take advantage of the West African market, the ECOWAS market, to actually incentivize growth and investment in this economy. But having said that, the truth is that there's no silver bullet. There's no quick and sharp recovery. It's going to be a U curve, which means the economy tanks. It stays for an elongated period at the bottom and then begins to pick up very strongly. That is what I think that's what the future holds, at least in the next Q4, Q1. I think that by Q1 or Q2, you will begin to see signs that the recovery is beginning to pick up, and then by Q3, we should be in positive growth no matter what happens.
And just as the fiscal authorities announced some measures to help boost the economy, the monetary authorities also had their plans. That will be next after the break. And just as the Finance Minister, Mrs. Zainab Ahmed, the Governor of the Central Bank, Mr. Godwin Emefiele, at the last MPC meeting for the year, was also very optimistic about growth in 2021, particularly with COVID-19 vaccines in the horizon. He believes the economic plans put in place by the government is good enough to take Nigeria out of the current recession.
Inflation will likely abate in the medium term, as domestic production is expected to recover following the resumption of economic activities post-COVID-19 lockdown. In addition to this, food inflation is expected to moderate as harvest season sets in. Monetary and fiscal policies are also expected to continue their broad-based stimulus support towards full recovery. This will involve fiscal measures to reduce unemployment, provide an enabling environment for private sector investments, and necessary support to the health sector to cushion the impact of the coronavirus pandemic. In addition, the CBN is expected to sustain its various intervention measures to boost consumer spending and support recovery. The committee recognized the supportive developmental roles of the CBN towards addressing some of the structural issues in the economy. The MPC specifically expressed optimism on the future impact of the disbursements from Agribusiness Small and Medium Enterprise Investment Scheme, the AXMIS, by 92.9 billion naira to 24,702 beneficiaries, Anchor Borrower Program by a sum of 164.9 billion naira to over 954,279 beneficiaries, and COVID-19 Targeted Credit Facility to households and SMEs by 149.2 billion naira to 316,869 beneficiaries. The committee noted the recent impressive performance recorded in the equities market, particularly the increased patronage by domestic investors, largely driven by low yields in the money market. The all-share index increased by 20.55% to 30,520.69 on October 30, 2020, from 25,327.13 on September 30, 2020. Similarly, market capitalization grew by 20.82% to 15.96 trillion from 13.21 trillion over the same period. This improved performance was largely attributed to positive third quarter corporate earnings as investors moved in to pick up bargain stocks. Committee observed a moderate decline in external reserve position, which stood at $35.18 billion as at November 19, 2020, compared to $35.95 billion as at the end of September 2020, as crude oil prices continue to fluctuate with downward pressure. Our outlook. Overall, medium-term outlook for the global economy is beginning to show a ray of optimism following the discovery of COVID-19 vaccines. In the domestic economy, available data and forecasts for key macroeconomic variables also suggest optimism in output growth during the fourth quarter of 2020, due to the positive outlook for most economic activities. Accordingly, the economy is expected to recover from the recession by the end of 2020, while the inflation is projected to moderate by the first quarter of 2021. Committee's considerations. Committee's considerations remain focused around tailwinds imparting upward pressure to domestic prices and key headwinds to output growth. The committee noted that inflation continued to be driven by supply-side disruptions arising from COVID-19 pandemic and other legacy factors. Key amongst these are security challenges in parts of the country, increase in food prices, and the recent hike in pump price of PMS and electricity tariff. MPC therefore emphasized the need to address structural supply-side issues by putting upward pressure on cost of production and unemployment. To address the public health crisis associated with COVID-19 pandemic, committee urged the federal government to make relentless effort to procure a substantial quantity of the COVID-19 vaccines to surmount the public health crisis and pave the way for a broader macroeconomic recovery in the country. Committee noted that the contraction had bottomed out since it moderated significantly from minus 6.1 to minus 3.62% during the third quarter. This was so because both the monetary and fiscal authorities had anticipated the impending recession and had put measures in place for its quick reversion. Some of these measures include the Economic Sustainability Program by the federal government and other CBN facilities targeted at households, small and medium enterprises, youth empowerment, and reduction in unemployment. It thus urged the federal government to maintain its initiative targeted at reducing employment, particularly amongst the youths, citing the recent NSAS protests and ensuing agitation by hoodlums as potentially disruptive to output growth in Nigeria. As a result, the MPC reiterated its support for the various development finance initiatives of the CBN to stimulate production and reduce unemployment. MPC further encouraged the bank to intensify its efforts by increasing funding to more beneficiaries so as to boost consumer spending and accelerate recovery from recession. On the financial markets, committee considered the improved performance in the equities market as a leading indicator of medium-term macroeconomic recovery. It thus urged the bank to maintain its policies on exchange rate and financial system stability to attract more investments into the equities market. MPC noted that credit to key sectors of the economy increased and encouraged the continued credit support to employment-stimulating sectors to hasten the recovery of output growth and improve employment, particularly amongst the youths.
Interestingly, Nigeria didn't have to deal with just COVID-19. A peaceful protest aimed at correcting some anomalies turned violent, and the result was destructions and more threats to the economy. The director of the African Department at the International Monetary Fund, Abebe Selese, had this to say about the economic headwinds in Nigeria and what needs to be done.
To say that, economic conditions in Nigeria, of course, for the last 4 years or so have been very difficult. In the wake of the decline in oil prices in 2015-16, since then, the growth has been quite anemic. There's been a lot of pressure on standards of living. So there has been this dislocation. As always, when you have these kind of economic difficulties, social protests are not uncommon. I think this is exactly why we've been, on the record in Nigeria about how really critical it is to get all of the policy-induced barriers out of the way to facilitate stronger economic growth, for the government to do more to raise revenues, to be, from non-oil resources, to be able to invest in health, education, which would allow people to be more successful at getting jobs, but also improve the economy's potential. So I think that development agenda that Nigeria has, I think, has to be tackled with gusto and vigor, so that the millions of jobs that the country needs can be created. And I think that agenda remains very pressing. I mean, these protests happened, of course, after we had closed. After the period where the data we looked at in making the growth projections for this economic outlook, and much will depend really on how these protests evolve. Lagos, of course, is a very important economic hub and contributes quite a bit of economic activity to overall Nigeria activity. So if these persist and are showing significant effects on economic data, we will internalize them in due course. It's too soon for us to know the implications and internalize that. Are we concerned? I mean, of course, we're always concerned when we see protests, particularly ones that are difficult, like the ones in Nigeria at the moment, but also anywhere in the world, right? So, we hope that there will be a satisfactory resolution there. And as for the support we provided Nigeria earlier this year, I mean, again, this support, of course, is to help to try and cushion the awful effects that this pandemic and the economic crisis that has unfolded has had on Nigeria. It's led to a massive decline in tax revenues, important need for the government to spend resources on health, education, and other important areas at a difficult time like this, and that's what the resources were intended for. And I think the government has committed to both provide us with an explanation of what the resources have been used for, and audits of how that has been used in due course, and we look forward to that in the coming months.
If only the Nigerian government will have the willpower to do just as he has said, channel resources on key areas like health, education, and areas that can stimulate growth, then our optimism for growth will play. Well, talking about optimism, even at the equities market that didn't witness a single IPO this year, optimism remains the watchword.
Cautiously optimistic, and this optimism is supported by IMF numbers that forecast a 5.2% growth for the globe in 2021. Obviously, it's not going to be evenly distributed, given that the pandemic has had varying effects on varying countries. Nigeria, because we actually had a twin challenge, COVID and oil price shocks. So because we're reliant on oil prices, especially for our FX reserves, the dynamics of crude oil prices and production will continue to influence the capital markets and the larger economy. Stronger collaboration between fiscal and monetary authorities is therefore critical to helping us come up with growth-stimulating policies that would allow us to emerge out of recession and begin to grow the economy again. We believe that in doing that, that recovery is going to be led by investments in infrastructure, investments in people, investments in policies that will create such laws as the CAMA 2020 that we're all celebrating right now. And I must say, because we're a market, next slide, that we always look at both sides of the equation. So there are downside risks. So it's not a slam dunk that we're going to have growth in 2021. There are some risks. And obviously the biggest risk is, having a second wave, a third wave, as some countries are doing right now, of COVID. Because if that happens, if we don't manage it well, we'll go right back into recession. The next thing to worry about is oil prices. We're recovering, but it's a very arduous task to try to predict where oil prices will be. So we just hope that those prices continue to go up. Those things will have significant impact on us. For example, the whole of this year, we've not had one IPO. So it has really affected companies. A lot of companies, especially SMEs, have declared losses or significantly reduced revenues, and the exchange is no exception. We're tracking, very double-digit negative to budget.
From the capital market, and now to domestic commodities market. Ahead of Christmas, we heard many describe onion as the new gold owing to the hike in the price of the commodity. We deemed it fit to get into the market and find out why this common commodity easily found in every meal appeared to be unaffordable at the time. The prices may have moderated now, though, but in this report, we look at the factors that drove the prices.
If anyone had predicted that the price of this bag of onions would rise to as much as 100,000 naira, most Nigerians would have disputed it. But it did happen, and it caught most Nigerians by surprise. Desperate times call for desperate measures, and so many devised several alternatives to onions while the price was rocket high.
Onions is something else now. I add the garlic to supplement, I don't just use only onions now. I add to it.
For almost 2 months, the price was almost unreachable, with many describing onions as a new gold in the land.
There is low investment in the hands of people. So if government should help us to provide that, I tell you by January, February, we are going to reduce this price of onion to, let's say, 10,000–15,000 naira. But if no intervention, it will last as long as a solution comes.
And several people gave different reasons for the price hike.
It was due to the insecurity to farmers, herdsmen disturbing farmers, protesters hijacking already moving goods that are in transit. So they are hijacking and doing stuff. So we don't have much that was coming into the town. The little ones they have will definitely be inflated.
The dams of the states was open. So when the farmers plant their onions, the rain come from God, and the dam was open. All in the farm is do damage.
With the reopening of the land borders, many expect that the move, alongside other policy actions, will push the supply curve beyond demand for reduced pricing of onions.
Yes, we have policies and good ones at that, but how well are they implemented to achieve desired goal? We'll be back in a moment.
2009, if you recall, President Yar'Adua did a Vision 2020. That was 11 years away. And here we are now in 2020, and none of those two plans have come to fruition. You will recall that this government launched the Economic Recovery and Growth Plan in 2017 on the back of the economic recession we saw in 2016. Not very much was achieved out of the ERGP, but now we are in 2020, and we've sort of kicked the goalpost away further to 2050. So it's all very nice and good to talk about the Nigerian agenda for 2050. I think the key thing here is to really focus on how you actually begin to implement some of these noble plans. And if you go back to even the very first one, that is in my own memory, of 2010, some of the objectives there are still laudable. And that one is even sufficient and quite relevant in Nigeria today.
Now, you've talked about implementation, which is a key issue in any policy that is being made by any government. Well, talking about steps the government would really or naturally take towards implementing some of these visions. We've seen the present administration inaugurating what it called the Vision 2050 committee, which is to be chaired by Mr. Atedo Peterside and, of course, the Finance Minister Zainab Ahmed as co-chairperson. What changes do you hope, to see in this seeing the economy, short to medium term?
The key, the most important thing I heard about that Nigeria Agenda 2050 is how to try and lift 100 million Nigerians out of poverty within a very short period of time. In order to do that, that means that the impetus of this plan must focus on the youth, because really these are the people that hold the key to growth in the future. The biggest problem facing the Nigerian economy today is, where do you find growth? In a world of declining resources, in a world where oil is becoming less and less relevant, and that's the mainstay of our economy, in a world where a lot of the other countries, major economies of the world, are also suffering as a result of COVID-19, how do you find growth? How do you revive this economy? So the focus of this plan must really be something that is targeted at the youth. And if the chairperson, Atedo Peterside, and the Minister of Finance, if they would organize themselves to kind of think, what can we do for the Nigerian youth today? My humble opinion is that you need to focus on education, you need to focus on technology, and you need to focus on healthcare. Because if you can uplift the quality of the human capital, then you actually have the resources in the future that can begin to transform this economy. It's not a question of, yes, we are lacking in infrastructure. Yes, we are lacking in quite a lot of other physical assets. But without the human capital to bring all of this together, we cannot be on the same page. And I have to say that perhaps in a world of rapid flow of information, people can notice a situation in Kaduna, and in 5 seconds is all over the world. I think the issue of social justice needs to be dealt with so that people have a sense of ownership and harmony with the entity called Nigeria. And so we must kind of think of how do we bring everyone together so we're all on the same page and understand that we all have the same problem to solve. Whether you're from Maiduguri or you're from Enugu or from Kaduna or from Lagos, we all have to sort of have the same view to tackle the same problem. And if we don't get that together, then it becomes quite difficult to organize people to be able to achieve the most noble objectives, no matter how beautiful that plan is. So I think that, wrap up, the plan must focus on the youth, and the plan must focus on education, supported with technology and also the health, so that we can have the right quality of human capital that can lift this country out of poverty.
Right, let's look at the economy broadly. Now, the country is definitely not in the best of times, as there are so many issues to consider from the macroeconomic landscape perspective. What is your broad-based assessment of the Nigerian macroeconomic terrain amid this COVID-19 pandemic?
Well, it's a tough time. We are going to be entering into a recession, I would expect, by the end of the third quarter. As you saw, the economy contracted by about 6% in Q2 as a result of COVID-19. IMF is projecting a 5.4% contraction of the overall Nigerian economy for 2020. So when you have 2 quarters of contraction, that puts you into a recession. This will be the worst we've seen in a long while. The last recession, if you recall, was in 2016. The economy contracted by 1.6%. So a contraction of 5.4% is more than 3 times the effect we felt in 2016, which was pretty bad. But if you translate that into numbers, inflation is now approaching 13%. Well, food inflation itself is above 15%. That means for the average Nigerian, the cost of food has been rampaging up, and that makes it more difficult. When you look at things like unemployment, we're now sort of about 23, 24%. But if you actually look closer to youth unemployment, we're closer to 34%. When you now unpeel that data, you're looking at something like 15 million people that have gone out of employment since COVID-19 began. So that's quite serious. So there's a lot of suffering in the country. And then how do you revive this when oil prices have gone down and the world is trying to move to renewable energy, electric cars, and yet our whole political economy is still tied to oil? If you look at the statistics of the economy in 2016, you will see that in a depressed economy, all the foreigners flee. So we had a very low foreign direct investment level in 2016. But importantly, the foreign portfolio investment, which has often been used to prop up the economy, also disappeared. So that means, therefore, that we need to kind of look inwards to understand how to resolve ourselves out of this situation. Unfortunately, it's a job that is politically will not be sound, will not be well accepted, but the government has now quite early begun to reform, and you've seen sort of the fuel price reforms and the regulation happening. You've also seen what's happening in the electricity and power sector. But one area that is closest to home is actually government expenditure. If you look at our budget, over 75% of our budget is spent on recurrent expenditure. If you think about a budget of 10.5 trillion naira, and most of it is being used to service maybe 3 or 4 million civil servants in the federal system, that tells you that's a misallocation of funding. So I think to be able to free capital up in order to find it and put it in more productive uses to resuscitate this economy, you have to find a way to achieve some cost savings in government. But that has to be borne equally. The political leaders need to show their own commitment in doing that by also deciding that, okay, this is where we're going to cut our own expenditure before coming to the citizenry and saying, look, we all want everyone to tighten their belts. You've seen a proliferation of taxes coming on, taxing businesses in a depressed economy. That's even more like kicking a dog and calling it a bad name, because many companies are suffering. They have not actually earned the income to pay those taxes. This is actually the time to reflate the economy. I know there has been some effort in terms of fiscal stimulus. There's 500 billion naira that's been announced. How that has been fully applied in the economy is still trickling down. But 500 billion naira is really 0.5% of GDP. So it's not significant when you compare to South Africa, where their own fiscal stimulus was about nearly 7% of GDP. So there's a lot of work to be done. The economy is in a difficult state. There's limited resources available. So one has to be creative. But the most important thing, you have to look first at yourself at home. Where can I save money? Where can I cut costs? And then use that additional cash to deploy into areas that can create growth in the future.
Of course, 2020 wasn't just all negative. We had some remarkable achievements as a country, just as the reforms that Ikechioke talked about. Yes, we switched to the December to January budget cycle. We ratified the African Continental Free Trade Agreement Treaty. The Companies and Allied Matters Act was signed into law, and a host of other gains. So we can only hope to build on the momentum next year as the AFCFTA is set to commence in January 1. Hopefully, we'll begin to see the impact of some of the moves by the federal government to lift 100 million Nigerians out of poverty. From all of us here on Business Morning, I wish you Merry Christmas.